What's going on, guys? This is Aaron from Departures Capital, and we're here with John Feneck, CEO of Feneck Consulting and Portfolio Manager in the mining sector. It's nice to have you back, John. How are you doing today?
Thanks, Aaron. Yeah, I'm doing great. Thanks for having me.
Definitely. I'm excited to be talking about gold and silver and everything else that you're involved with. So it's, a pleasure to have you back on. Let's start by talking about everything you've been up to since we last spoke.
Sure. So I have to look exactly at the date, but I did PDAC in June, which is in Toronto, 17,000 plus attendees. I was interviewed by Kitco there. I've done a series of interviews this summer. That particular Kitco interview was David Lynn, if anyone wants to check that out. It was a little bit controversial in that I was calling for a recession then. I was calling for higher interest rates then, which is counterintuitive to being a gold or silver bull, right? So I try to lead your listeners and other viewers down the path of, this is the way I see it. Whether or not it's going to help me or be a good time to invest, I'm just going to try to lay the groundwork for you guys. And I don't think enough people do that because they've got agendas, right? And so I said that on Kitco. I just did an interview with Kitco again last week. We got a really great response to that, and basically reaffirmed that inflation has remained stubbornly high. We think interest rates are going to continue to go up, and the Fed would be hawkish, which is, you saw it just yesterday, another 75 basis points. But we also attended Denver Gold as well as Precious Metal Summit, both in Colorado, over the last 8 days. I just got back yesterday, and I had over 40 CEO meetings there. So my thing, Aaron, as we'll talk about a little as the show progresses, is to go to management first before anything. I want to get information from them in terms of what they see as potential problems more than potential benefits to their stock, because I want to be able to avoid stocks that we've seen this year that have blown up or gone bankrupt. There have been a few in the mining space, and it's been painful for those investors.
Definitely. So, with interest rates climbing, it's been a very tough environment for most sectors, gold included. Where do we go from here? And what are you looking for right now when it comes to investing into the precious metal sector?
Sure. So we use a rifle approach in a market like this. We don't buy the GDX or GDXJ just yet. We have in the past, and they are holdings of ours, but they're not larger holdings of ours. We use what we call a hub and spoke structure. So the spokes being individual names, like we'll talk about today, that are how we use our rifle approach, right? Little juniors or mid caps that maybe the average listener doesn't understand or know. And then the spoke being, the hub being the larger cap names like Newmont or GDX or whatever, right? So you build your base around that. And then we have a lot in spokes right now. We have a lot of stuff that's in the periphery because they've been beaten up so badly, Aaron. I mean, some of these stocks are down 60 to 80%, as you know, from their August 2020 highs. And so they're presenting a tremendous value. So as value managers, we're trying to find value in a tough market like this.
Definitely. So what are some of the catalysts you see for mining equities as we go into 2023? Like, what should we be looking out for? What should we be excited about?
Sure. So, one thing that we may get to later is the gold prices held this 1675 region reasonably well. I know that it feels painful for when you look at the chart because we've come off of that 1950 plus range, right? And it's been a long, painful year for investors again after last year. But you have to look at each individual company and what their cost of doing business is, right? Many silver companies, for example, are only profitable with $20 silver plus. I know a handful that are not, that they're profitable at $9 or $11, right? So that's positive. You're still going to make money in this market as we speak. Gold is the same at 1675. There's many producers that are 1100, 1200 AISC, all in sustaining costs, so they're not getting crushed. There are some, however, that costs have gone up, and their costs maybe are 2,000 an ounce now. So we avoid those, and we're buying the stuff that either has a low cost profile in a better part of the world, has a yield like Newmont or BTG, stuff like that. So as far as looking forward into the next 6 to 12 months, my first catalyst is always management. I've mentioned on your show before Aftermath Silver, which is AAGFF. Also Vendetta Mining, which is VDTAF. Michael Williams is involved in both of those names. You know, he's been serially successful in the mining space, right? So you know, if you look at his track record, he put, I think, about 29 million Canadian into a project that got taken out by Kinross for 140 million, you know, just a few years ago, right? So then he starts Aftermath. He's CEO of Vendetta. He's got two new companies that he's involved with. So one of the screens that we use, Aaron, is, have you done this before successfully somewhere else, right? Because there's a lot of little mining companies out there that aren't led by someone like Michael that has the experience that's necessary to navigate this kind of market. So, you know, with Aftermath, we've got, you know, two major projects in Peru and Chile that look really, really good to us. Don Durrett, who's one of my friends and also a competitor, but someone who runs a great website for those of you that don't know it, called goldstockdata.com. Very inexpensive to get access to some of the names we'll talk about today. But, you know, Don just mentioned him in his top 15 names for development companies in silver, because they have so much silver in the ground. So, you know, at 13 cents, you have to say to yourself, okay, this was $1.34 or something, you know, literally a year and a half ago. So it's down 90% in a year and a half. Is that normal? No. I mean, you have to just pick a spot and start buying some of these names, because they are going to make it, right? In our view. Vendetta is a totally different company. It's in Australia. Pegmont is in a decent jurisdiction there. We think they can go into production within 24 months. And that's lead and zinc, so it's base metals. But if you look at the news flow back in December of 2021, they got you know, an investment from an Asian entity, and we think that the market completely overlooked that because it was during tax loss season. But we like to see these 9.9%, you know, investments from outside companies, because sometimes that turns into a purchase down the road or a more significant investment, right? If the company is doing what they're supposed to do, and they've got a great geo there who has a background from Ivanhoe Mines. So just a couple other names. You know, Fabled is led by another serially successful mining guy in Peter Hawley. Peter is on Fabled Silver Gold, and he's also on Fabled Copper. The tickers are FBSGF and FBCPF for the copper. We just bought some copper this week, in full disclosure. Not a lot, but you know, it got ridiculously low yesterday to 0.012 cents. I mean, it's like, if you look at the chart, that was a spin-off of Fabled Silver Gold. You know, Aaron, I think there's a lot of short selling going on. I just talked to, as I mentioned, 40 CEOs over the last, you know, week and a half, and I'd say 8 or 9 of them showed me, you know, literally, here's our blotter for the last, you know, number of months, and look at the short interest pickup in our stocks. I think these shorts are coming out of, you know, Canada or Europe, because I don't see them too much in the US. But, you know, hopefully, you know, they'll get smoked at some point in the cycle here, because I've seen that happen before in January of 16, where these guys were really over their skis with shorting. If you looked at the GDXJ, for example, then it was 24% short at that time. And a quarter of the shares of that ETF were short, right? So I mean, like, that was extreme. We're not there yet, but we're getting, you know, really bombed out in some of the names I just mentioned, the 4 stocks I just mentioned. Another one that comes to mind is Thunder Mountain Gold, which is THMG. They have a great relationship with B Metals, which is a baby of Clive Johnson's. Clive, you know, won CEO of the year in the mining space for BTG 2 years ago. So here's a guy who, you know, started another company at B Metals. You know, the BTG has funded some of that. Now B Metals has a relationship with Thunder Mountain's South Mountain Gold Project, which is in Idaho, which is a great jurisdiction. It's the 8th best jurisdiction in the world. So, you know, that, if you look at the news flow, has potential for growth here over the next 3 months. So again, something you don't have to wait, you know, a year or 2 years for. All of the names I just mentioned have, you know, near-term catalysts or are doing good things, I think, in terms of, you know, moving forward.
That's great. So, you know, are there any other sectors in the market that you're interested in right now outside of gold or silver? Because I know that is pretty much, you know, your main focus.
Sure. I like energy. I run an energy portfolio as well. So we've got a 3-year record on that, a little longer than that. I used to represent MLPs. So MLPs would be like a ETF, like AMLP. It's the largest in the industry, and MLPs throw off a good yield, right? They have less of a risk profile than the average energy stock typically, and they throw off some yield, which is attractive in a yield starved market that we're coming out of. But yeah, I like some hydrogen names. I like anything with the battery metals market right now. You saw Tesla over the last
Mhm.
2 years really get aggressive about how much is needed in commodities to make their cars go, right? And there's just a ton of little energy stocks you can look at, and so that's one area that I like a lot. The other areas that I like are to short. I think if you look at international, it's an absolute disaster. So when I see people like saying, "Oh, international is a good value here, emerging markets are good value," yeah, maybe, but when you look at the charts, they're broken. So why are you continuing to buy a falling knife, right? Like if I buy a falling knife in mining, I know the CEO, I know where all the bodies are buried, so to speak. Like I know exactly what I'm getting because I've done the homework. When you buy an ETF like EEM, which is emerging markets, you're just buying all these little countries you've probably never even been to and crossing your fingers and say, oh yeah, I hope this does well. Like that's not a strategy. So, emerging markets tend to do badly when the dollar rages higher. And you and I were talking about that
Mhm.
pre-show, how the US dollar right now is a few ticks away from a 20-year plus high. So emerging markets typically don't do well in a market like that. So we've been short Europe and short emerging and short a bunch of things international, which is, really helped out this year.
Yeah, it's definitely an interesting market to navigate right now. So, a lot of people thought that gold would be a safe haven during times like these. Why do you think it's performed the way it has when inflation has been picking up so substantially?
Sure. So that's a great question. And, as I said earlier, gold's been very frustrating this year, but I think the positive takeaway is when you look at other asset classes versus gold, year to date, we've got a lot of pain in the Russell, the IWM, a lot of pain in the Nasdaq, QQQ. The S&P just broke 3,900. The SPY it broke 3,800 today, which was another
Mhm.
level of support. So when you look at gold relative to other asset classes, it's not doing as badly as people think. It's just that look, as someone who has money in gold stocks, of course I want gold to do well. It's just we have to hold, if we don't hold this 1675-ish kind of range, we must hold 1575 because if you remember, that was the breakout moment years ago where that was major resistance, and then now it has become support. So we need to hold 1575, which is $100 lower than here, and I think we will because we're in a very uncertain period of time, in history. So I would just tell people to be patient.
Yeah, and gold was one of the only things in the green today, despite the markets dropping quite a bit. So seeing days like that, it's encouraging, but obviously day to day, it's like could go the total opposite the next day. But watching those key levels for sure. So for our younger viewers, because we do have, quite a young viewership here, and that's something that's been a goal of mine is to educate them on not just, the high growth tech stuff, but also commodities, gold and silver, things like that. That's why we're talking. Do you have any advice for our younger viewers navigating these markets, gold and silver? I'd love to hear it.
Yeah, so since we met last, fourth quarter of last year, I've had a consistent message on your show, and because you've asked that question, I think every show, and I've said the same kind of
Hmm.
thing in different ways, which
Hmm.
is number one, I think the broad market is going to correct, which it is. Number two, you need to align yourself with a financial professional, whether that's a financial advisor or someone like me that can help you in commodities. Just buying like 6 newsletters, like I see a lot of young people do, or watching a
Hmm.
bunch of YouTube videos. Like it's partially okay, but like it's not a full plan to like, feel comfortable. Like when I go to sleep, I feel really good about what I own, right? I have had times in my life, Aaron, that I have not felt that way. 0809 being one, right?
Yeah.
Jan of 16 felt terrible because January was conference season for me. So I'm sitting in this conference room and you can't check your cell phone, right? Because you're in meetings and you look and you got executed on all these, trades you had, limit orders, and you're like, how did I even get filled in this stuff? I mean, that's the market we're in right now, right? Where you set these things away from the action and you can still get filled, and it's mind-boggling. So I think you need to just feel comfortable with that price that you're putting in terms of a limit order, that you can live with that and live with it for potentially months because we're in a challenging market. So another piece of advice would be to just rethink think your expectations for 23 and 24 and years beyond, because a lot of the easy money in the stock market has been made, in sectors like technology, biotech. I mean, these sectors have done so well since the 08-09 crisis that you have to go back and look at 15-year charts. You can't look at 2 or 3-year charts. You have to go back and look at what prices things were then, right? Like Amazon, is maybe attractive as a trade here, right? But you look at the price in 08-09, it was at $10. So it's up multiples from there, right? And I'm not picking on Amazon. I'm just saying, like, you need to do the work on all of your stocks. Like, one of the reasons we've been, short travel and leisure is because I think that, travel and leisure is getting really expensive for people, right? It's like, it's expensive to get on planes, do things with your family, go to hotels. They have all these new fees. Parking is doubled at some of the hotels that I've gone to. I literally went to a hotel the other day and it was like 40 self-park, 70 valet. And I'm like, what? Like, it's just to park my car for a few, an hour or like, a day or whatever. It's just a joke. So these companies are making up for less occupancy on a cruise ship, in a hotel, by raising prices. Is that fair to the consumer? No. So, we're going to short those names in the sense that eventually things will change and people will put their foot down and say, I'm just not doing this anymore.
Yeah, I agree with that. So, all right, John. Well, thanks. It's been a pleasure. And I look forward to having you back on as we navigate these interesting times. So, hopefully we can have you on when hopefully gold starts to run and, commodities, and those will be the fun times. But we got to get there first, right?
Absolutely. Yeah. And if anyone wants to check out, our website, it's feneckconsulting.com. And we have a new newsletter that we've, kind of renovated and rolled out this year that travels through the whole commodity world and covers everything. So maybe that might be interesting for you.
Definitely, John. Well, thanks a lot, and I look forward to having you back on.
Thank you, Aaron.
If you like these videos, kindly hit that subscribe button and the bell for notifications. Drop us a comment down below. We'd love to hear from you. And finally, always remember, Departures Capital is for information, education, and entertainment purposes only. Don't buy or sell a stock because you heard it on here. Buy or sell a stock because you've done your research, you've done your thorough due diligence, and you're making your own personal investment decisions for yourself. This video is not financial advice. Furthermore, this video may or may not have been sponsored by the companies that we've profiled within this video, and we may or may not own shares of any of the profiled companies in this video. If you want to know the full disclosure details, check the description down below, along with thoroughly reading our disclaimer. Thanks so much for watching, guys, and I look forward to seeing you in our next video.